Hello and welcome. Our topic today is one many people are talking about, the Federal Reserve and rate increases. I'm Becky Freemall with ValleyStar Credit Union, and joining me today is Mike Worrell and Justin Barnes with our executive team to offer guidance on what all of this rate hike talk means to us. So, Mike and Justin, first of all, thanks for joining me and for your willingness to share your knowledge.
Thanks for having us.
Happy to
Absolutely.
do it, Becky. Thank you.
Yep, absolutely. So, Mike and Justin, together, your experience in the world of finance equals a combined 50 years. We're talking loans, savings, credit cards. You've watched the ebb and flow of finances, the Federal Reserve, and for quite some time. And accordingly, I so look forward to your insight, as does everyone listening. I'd like to start with a high level question a lot of people are asking. The Fed increased rates. What does this mean for me? And that's my main question, but I kind of want to go a little more and just kind of expand on that with how do we navigate this the smartest way possible? And I think more importantly, how do we remain calm and focused? Because change, no matter what it is, can create some added stress for people.
Agreed. And Becky, it's important to remember that a rate environment like what we're seeing coming up now with the increases is not unusual. We're not really entering uncharted waters. It's just that it's been about a dozen years since we've had to navigate this. And what's happening is what we're witnessing is the feds are attempting to stave off and curb inflation, and that affects all of us. And overall, inflation is generally caused by like a rise in demand and of goods and services. And it's been proven over time that increasing the cost of the funds that you borrow will curb inflation. So that's essentially what's going on now.
Yeah, to echo a little bit of Justin's thoughts, this is nothing new, but it is new to almost an entire generation, right, Justin? I mean, there's people, for example, my daughter is 23, 24 years old, and she's not really aware of being paid dividends on checking accounts or savings accounts of that type of thing. Certainly skipped her generation because of the environment we've been in. But again, it's the short-term rate hikes and stuff are for the general public really not of concern. It's the long-term, when the long-term stuff starts to kick in, is when it really starts to affect the everyday in and out versus just the, I guess, knee-jerk reaction that we're seeing now on the news to gas is going up, it's 80% more to go to the movies, those type of things. That will flatten itself out, but will it flatten itself out where we are today, or will it lower itself? It's the real question, right?
And I would gather at ValleyStar, Mike, to follow up on that, the credit union is tracking this all closely when it comes to decisions and making those sound ideas moving forward.
Yeah, for us, I mean, we have obviously due diligence is a huge part of the organization, Becky. We take managing our members' money extremely seriously. So we have monthly, what we call asset liability management meetings, where we'll go over deposits increasing, loan rates increasing. We'll look at our actual data, our members' data. We forecast out losses. So we have a thing called allowance for loan and lease loss. These terminologies or acronyms that people use throughout articles that nobody knows what it means. Basically, that's money we set aside for future losses, right? So just think of it that way. It's a loss. Ours is extremely well funded at ValleyStar. We're actually overfunded, meaning we have more money in our allowance for future losses than the majority of other organizations. And then furthermore, some of the regulations that came out of 2008, 9, 10, Dodd-Frank and all that stuff really put regulations, to be specific, on financial institutions to have certain thresholds in stress testing that we have to complete. Some of that is instant rate shocks, right? So you'll hear that in the news coming up where it's up 1% or 2 or 3 or now 4%. Overnight, it goes up. What does that do to your balance sheet, right? In those meetings, we have those monthly We work with several partners, third parties to verify the information. So it isn't just us verifying our information, right? That would be weird, right? Like, yeah, everything's good over here. We pay a third party that verifies and helps guide us along the way. And in every case scenario, from the last call that we just had with a couple of our vendors regarding all of interest rate risk, IRR, ValleyStar is in a very good position. Would a 4% overnight increase certainly hurt the organization? It would hurt every organization, but the good news for us is we're more than sustained through it with every case scenario that they could throw at us. So that's really good news.
That is good news. Let's look at some of the various credit union products. And I want to start with mortgages on how does this impact homeowners, and what are some of the smart ways to navigate? And I should say homeowners, people who are actually home buyers who want to own. What are some of the smart ways to navigate that whole home buying space right now?
Well, mortgages. So it's a very interesting question. And it really depends on, for yourself and your family, it's probably one of the largest decisions or biggest purchases most people will make in their lives is their mortgage, right? So you need to sit down and decide what type of mortgage loan are you looking for? There's so many different offers out there, right, Becky? Let's take, for example, a 7-year ARM. So if you aren't planning on staying in the home, it's just to start a home for you. Maybe it's your first home. A 7-year ARM may be a great product for you. When I say ARM, that's adjustable rate mortgage. So that means the rate adjusts every 7 years. You're locked in at a fixed rate for 7 years. And then at the end of 7 years, it'll adjust to what prime is, which is set by the Federal Reserve, which is how we began our conversation with. They're raising rates almost every month or week, it seems like. So it's just deciding what you plan on doing. If you really know you're not going to stay in that home, that may be a great product to look at, one of the mortgages that we would offer. But I'll defer to Justin. I mean, he's the chief lending officer on
Right.
that.
Yeah. I was just going to say, this is Justin's realm for sure. I mean, I don't know. I've heard some people say maybe this is the time that you look at that 30-year fixed rate loan. What are your thoughts, Justin?
Well, the 30-year fixed rate is where everyone wants to be. They want the security. I don't blame them. That's what I have with my home. But as we look at this and we see interest rates go up, the adjustable rate mortgage, for example, the 7-year ARM can be a great tool. Mike brought up the 7-year ARM a minute ago. And so what typically happens with interest rates is, we're detuned to this because we haven't seen rate swings in a while. Like we said, it's been about a dozen years or so, but typically what'll happen is we'll see interest rates creep up to stave off inflation. And then within a window of time, certainly and likely within 7 years, we might see some correction or likely see some correction on that. So the advantage of a 7-year is the financial institution can actually price that more favorably because they're not concerned about pricing it on the 30-year. So you get a more favorable rate. You may not stay in the home, you may move. Even if you do stay, you could use that 7 years to really watch the rate environment. And when you see it come back to a more favorable level, that would then be the time to go ahead and refinance for the 30-year. You could even request that your lender, if you go 5 years and finally rates improve and you go ahead and refinance, you don't have to get another 30-year. You could get a 25-year. So you're still on that 30-year pace relative to the term at which you pay off the mortgage. So I think it would be important, and we have a great team to talk to relative to that and relative to mortgage, but it's really important to match the product very specifically to your plans and your concerns, because it's a business decision for a consumer. Homeownership is, and the mortgage process. So, and we're always honored to help walk people through that. We're humbled to be able to have the chance to help folks with homeownership, and it's our honor to do so.
Another question just would be, what about credit cards? And Mike, I'll start with you on that one.
Yeah, credit cards are kind of a unique, a unique product, right? So there's all kinds of different types of credit cards that have come out since American Express was the first one to the table in the 70s, I believe, Becky. But so a credit card at itself is, they're basically a line of credit, right? That we're extending to people based off their credit history, how they've paid back. Times are changing, so now different organizations are looking at different things to make decisions. But there's usually two types of credit cards. One's a fixed rate. So that means if you get a credit card at 7.99%, it's going to stay at that rate for X amount of time. Then there's the variable rate one, where that's kind of tied to prime. So again, that's tied to the Federal Reserve. So as that rate goes up, so doesn't your credit card rate. So again, I think it's what we're trying to talk to people about. And if they can get anything from this podcast, it's kind of like planning out your financial future, right? Deciding what it is you want to use the card for, not just get the lowest rate out there, or the one that gives you the most, I don't know, the pots and pans and all those things you can search online. It is, what are you using the card for, right? And then from there, you can make your decision. But it is worthy to note that even at a fixed rate, there's a universal clause in most credit card companies' disclosures that say they can change the rate and do whatever they want. I know that Congress was trying to get that removed from the big credit card companies a while ago, and I'm unaware if it ever was removed. But the good thing about credit unions was we honor our rates, and we don't have a universal credit card clause in our contracts with our members. So,
yeah, with the fact that we're seeing this rate environment, there's been a lot of us, me included, that you may have credit cards at a certain fixed rate. You kind of plan on that, and even if it's been a variable rate, it's looked like a fixed rate to us because the rates have been historically low for over a decade. So I think there'll be a lot of us watching where that rate is more often on our statement or our mobile app with those credit cards, whatever the case may be. And certainly, if you consider which one to use during this time frame, as Mike said, you might consider those that are in the fixed rate category, even though that they can change them from time to time. But it's also important to note that in using a credit card, if you use it for something and then pay off the balance at the end of the month, you're paying within the agreed upon window, and you would actually avoid interest no matter what they decide to do about fixed or variable.
So along those lines, since you've both discussed fixed rate, variable rate, there might be some people that are listening that are kind of not lost, but might be like, what in the heck are they talking about? So when you're talking about fixed rates, you're talking about variable rates, which products fit under which category? And then how do the fluctuations from the Federal Reserve impact each one of those products?
All right. So, for example, some examples of fixed rate loans for any of us that have gone and gotten a car loan, maybe even a personal loan to consolidate debt, and certainly back to the 30-year fixed rate mortgage that we discussed a little bit. Those are legal contracts where you sit down and sign and agree upon a rate being fixed for X amount of time. Those are your true, and you're given a payment, and that payment is not going to change until you've paid off the balance. The variable rate loan bucket is going to be the credit cards, as we've talked about, and also another product that is called a home equity line of credit, or also called a HELOC. They typically follow the Wall Street Journal Prime. Many cases, a Wall Street Journal Prime plus a margin of a half or something like that. And those can change, as Mike mentioned, those can change each month. That's part of why folks have been watching everything so closely when we start to see these rate increases, and it's understandable.
Hey, Justin, before, sorry, Mike, I'm going to jump in real quick. You just said prime. I feel like that might be a word people will hear and be like, what do you mean by prime? What exactly are you talking about? Could you just delve into that for a second?
Sure. Prime is known as an index. So the Wall Street Journal issues a prime funds rate, and it's based on the value or cost, either way you look at it, of funds overnight. It's really on a monthly basis that they look at it relative to any adjustments. But the Wall Street Journal Prime is kind of known to be a par, if you will. So many, because it's fluid and changes with where the markets are and the cost of funds or value of funds overnight, depending on whether you see it as an asset or liability, depending on what you do in the financial sector. It's just a very strong indicator of what your funds are going to cost when borrowed. So it's watched very closely.
Okay, I appreciate it. I think we talk about prime, we kind of throw that word around a lot, but I'm not sure everyone knows exactly what that means, other than that their credit card is prime plus whatever. And that's
Right.
that's all they got. All right, Mike, it's all you now. I won't cut off anymore.
No, I think there's a lot to that. I mean, the terminology in the financial world can be confusing. I mean, we're all guilty of it because we all work together. So we'll find ourselves talking in acronyms and not knowing what we're talking about, you know. But basically, the Federal Reserve is used to require, well, the Federal Reserve used to require banks and credit unions to keep a percentage of their deposits on hand, right, for overnight, right? They got rid of that in March. Well, they moved it down to 0% in March of 2020. So some of that probably had to do with the pandemic and other things going on. But by moving that, meaning you don't have to keep the reserves on hand, it allowed banks and credit unions to lend more and then not borrow from each other. So that's really where it is banks borrow from other banks if we need money. And then the average rate that we're charging each other, then we have to obviously mark that up to the consumer. And that's kind of where the prime sets in if you really got down to its basis. I think the record high was about 20% in 1980, 81 was what was required to keep on hand by the Federal Reserve. And times have changed in that manner, of course. But again, I think it's back to that financial planning. And it's great that we're a credit union because we have tons of resources. Not only do we have people that will go out and speak to large groups, but we also have one-on-one consulting, tons of stuff on our website at Your Money Guide that the marketing teams put together that people can really go in and start to dive in and learn as you go. And then, of course, any one of our 7-8 locations, you can stop by and speak with anybody about any type of financing you'd like to do. Because again, credit union is driven off of our members, right? Every member gets a vote. We don't have a board of directors that are shareholders. So it's a totally different environment when you're working with a credit union versus some of the larger banks.
You know, talking about all this interest brings me to a question about credit scores and just how do credit scores impact all of this?
Well, Becky, credit score can be really important for all of the products that we just discussed. No matter what the Federal Reserve does with interest rates, perhaps the largest indicator of the rate you're going to pay is still going to be your credit score. You know, the better your credit score, the more favorable rate you get as a borrower, as a consumer. It's been used as a pretty close guide and tends to be a really good indicator of someone's propensity to repay their debt on time. So, I mean, financial institutions and credit unions included, you know, we look at these scores, and a higher credit score kind of tells us that you have a higher level of financial discipline, you know, how you use your funds and any borrowed funds, and if they're paid back on time or as agreed. So it just shows us you have the credit score shows, a high credit score shows you have a higher propensity of paying us each month. So it's less risk to us and the rate's lower to you because you've done your part as a consumer when you've paid on time. So, and another factor in this, and this doesn't really have to do with a loan, but credit scores spill over into many other things. It can affect the cost or price of your automobile insurance because they look at it as risk. Many employers, including those in the financial sector, for certain will evaluate credit score for a new application because it does speak to discipline. And that's a big factor when bringing someone onto your team as an employee. So it is really important to monitor and work at on your own. And there's resources out there for that. And certainly, you know, ValleyStar, when I've got lenders in many cases, as they evaluate an application, if there's something on their credit report that is easily fixed by that borrower, by that member, we go into a consultative mode to say, this we're able to approve you today, but this is impacting your score, which is impacting your rate. So this would be something that you want to look at. So we're honored to do that at any turn and every opportunity. So another thing is, if we were to go into an economic downturn, there will be a group of people that has strong financial discipline that might still be affected. They want to pay, but inflation is impacting them. Maybe there's some loss of income in the household. So it happens from time to time that credit scores drop from other factors. And that's where the credit union tries to play a role. We do try to look at not just the score, but why the score, right? So we take that as a high level of responsibility to do our best to kind of understand the situation and try a way to still figure out how to make that loan to that borrower.
I think everybody uses the credit score now, even the industries that pushed back on it, like hotels and things of that nature, have gotten into looking at credit scores, and now it's evolving, right? Now with all this data world that we're living in, credit score is just one factor that some people are looking at. And there's certain companies out there that some people have heard of. Maybe they've heard of financial technology. They call it fintech. These companies are coming up with ways of getting loans done quicker, faster than banks and credit unions. But if you look at it at its core, right, Becky, that's how credit unions started. We started by being that person that would lend somebody money that the bank said no to. And it's our job to stay in that lane, right? That lane involves, like Justin said, it's that one-on-one time with the member, asking those questions. We're not just looking at a credit score and saying, all right, you're a 610 credit score. By the way, the highest the credit score goes to is 850, and the lowest it goes to, I'm not sure, Justin, what is it? What, 300, 400? I'm not even sure what it
Down
goes
in the low
to.
fours, down in the low
Down in
fours.
the low fours. So the higher that number is, the better off you are generally to getting cheaper products and things. But again, back on looking at the credit score, it's one factor in looking at underwriting a loan for us as a credit union. That factor may be the pricing factor, right, Justin? It might be what we use to price the loan, but it certainly isn't an automatic denial because somebody has a certain credit score. Or at least under my leadership, that will not happen here at ValleyStar. It's a picture of somebody's financial well-being that we want to look at. We're designated low-income credit union here at ValleyStar in the areas that we serve. And what does that mean? That means that the more than 51% of the households that we serve make a little bit below the average of income across the United States. So having known that if your income isn't through the roof, like we're in Greenwich, Connecticut or something, that we fit that space. We need to figure out, how do we lend to these people that have been loyal to us, loyal to the credit union? They're in the community, people know them. But like Justin said, they just had a little bump in the road. Something happened, sick, lost your job, numerous things that can happen. It's called life. And it's our job as the credit union and as working for our members is to find out how we can extend that to them in a reasonable way, in a reasonable time frame. But it definitely takes a little bit of work. So
my final question is, we've shared a lot of information to everyone listening. And Justin, I'll start with you and I'll wrap with Mike. If there is a way to distill down in a bullet point or two, some advice, some parting thoughts that they could walk away with, our listeners, what would you share on how to navigate maybe this next year or so?
Well, I would say, Becky, as you look at what you have borrowed as a consumer, look at the type of it and look at the terms. You know, if it's a credit card, it's very good chance that it's variable. As Mike mentioned earlier, those banks have the capacity to go up on those rates. So as a consumer, you don't know how far they're going to go. So if you were going to work on curtailing debt within your own household, I would start with those debts that are variable, get those balances down lower if possible, or paid off if possible. Another thing is you can look at your loans. You can look at a loan that you might have for your home versus a vehicle versus a recreational vehicle or an unsecured loan, and look at what those rates are. And if there was a way potentially, if you had an unsecured loan that was a smaller amount but a higher interest rate, you know, work on paying that one off. You know, as the rates are higher. And you might even consider, if you have a number of smaller things that you're paying on, it may be an appropriate time to consider a consolidation type of a loan, to where instead of making, you know, 6 payments, all of which the interest rates might be going up, for example, on credit cards, perhaps, you know, we could talk with you about, or talk with someone about a home equity line of credit. And because it's using the equity in your home as collateral, the interest rate is much lower. So those are some things that could be evaluated as a consumer.
Mike, your thoughts?
Well, I think Justin hit it right on the head. Is number one, you know, pay your bills on time, right? And that's critically important. Most organizations give, oh boy, Justin said 10-day grace period, I believe, 10 to 14-day grace period. And I think that was originally extended because of the US mail, right? Now with electronic payments, the grace period's still in effect, but certainly payments can happen a lot quicker. So number one, pay your bills on time. Create a budget. Again, I've mentioned, you know, your money guide, part of what our credit union does. Use us as a resource, stop in any one of our branches. Monitor this, you know, don't ignore it like it's just happening to everybody else. Everybody's paying more at the pump and stuff like that. If you're looking at how do you maximize your money, you know, sit down with a certified financial broker or an accountant. We work with several here. Justin and I cannot give legal advice on where to put your money. Keep an eye on CD rates, right? So certificates of deposits. There, I'm using acronyms again, Becky. But you know, that's another way of locking in your money at a fixed rate for a certain amount of time. The longer the term, usually the higher rate that will be offered for something of that. I don't, you know, money market accounts are a little bit more fluid, liquid, meaning you're going to get a higher rate on a money market account. And you can also access that money. I think it's 6 times within a certain time period. But certainly taking your money and getting your money to work for you, right? I think that's kind of critically important. That all begins with education. And that education needs to start from within the person to say, hey, I just want to look at my finances. I might need somebody to help me through that. A lot of people are nervous or scared to ask about that because, I don't know, maybe they don't feel so good about it by talking about finances, that their credit score is low and it's almost embarrassing. It's not embarrassing to us. I've been there. I think everybody on this call's been there where, you know, you've gotten yourself too deep in water and you don't know how to get out of it, right? You just really need to reach out, talk to people, and specifically talk to us here at ValleyStar. We're here to help, and that's what we're established for. And our board of directors, our mission is really to help people become financially better off than they were prior to being a member with us. So that's kind of where I would send people, you know, really pay your bills on time, try to think of some type of plan. Don't be reactive. Usually it takes somebody losing their job and sitting down when they're really focused on anything. Maybe just try to do a little bit before something tragic happens. And I think your life would be a lot better off and a lot easier as well.
Mike and Justin, thank you so much for taking time to talk with all of us today.
Thanks for having us.
Yeah, absolutely. This is a very important topic to us, so I really appreciate it. Thank you, Becky.
We appreciate the time you took to walk us through these rate changes with the Fed and how we can move forward during this, let's just call it a dynamic time of change. For those of you listening along with us, if you have any questions or have an idea for a future financial wellness podcast, just let us know. Email us at learn@valleystar.org. And if you prefer to dig around yourself, you can find plenty of information on our website, valleystar.org, where we speak your language.